All right. Well, hey, Dave, thanks for having me back. I always enjoy being here at the Festival of Traders. Thank you, traders, for being on here. Evening for most folks, and I'm really looking forward to this. And I'm going to go pretty fast, run through the material. I might just get done early, but if we got good questions, have good discussion, we'll definitely take the time to go through those. So again, I'm Dean Jenkins, founder of followmetrades.com. I run a stock alert, stock picking service. I got some training courses, got a trading room that we run in the mornings. But tonight I want to talk about kind of the core of my technical analysis in trading, and I call it East meets West. It's where I combine Ichimoku Cloud and Elliott Wave, and they're completely different analysis. But when they agree, some really good things can happen. And it's good when you have completely different systems agreeing and confirming, a up move or a down move. That's, as traders, that's what we want to know. What's going to happen next? Things going up or they going down, right? So please ask questions as we go. I'll answer them on the fly, and again, just want to have a good discussion and share this information. I love that question for Jake right at the end. Do you day trade? And he said, no, I hate it. I think I'm with him. I used to day trade a lot, and as he said, it's stressful, and it's becoming more and more difficult. So I trade a little bit longer time frames as well. My average hold time is about 2 to 6 weeks on trade. Sometimes a few days, but average about 2 to 6 weeks. Let me show you, before we get into the material, let me show you a trade we're in right now. We are long XPO. So it's a trucking company. They've already reported earnings. And we got in here at this blue line, and I'll explain some of these indicators and the setups here, but we got in at 82.41 yesterday and already having a good day. And we got a target up at this green line at 102.50. So how do I come up with that? Well, that's what I'm going to walk through. So we're long XPO. That's one we took today. And we are also short Verisign. Already reported earnings, and you can see they are heading down. There's no question. We took a short. And we're in profit on this one as well. I've got a target down here at 166. So again, how do I come up with this? That's what we're going to discuss. How do we set these trades up? How do we find them? All right. So let's jump right in. Of course, all trading involves risk. I'm going to be showing live trade ideas and some, what I'm doing. I'm not a financial advisor. I'm a trader. I'm not giving financial advice. So each person is responsible for what they do. Right. Here's what I'm going to walk through. I'm going to walk through the tools that I use in my trading and in my chart, my technical analysis. Talk just briefly about Dow Theory. It's an important component of analysis. A brief overview of Ichimoku Cloud, a little discussion about Elliott Wave, and then how I combine Elliott Wave, Ichimoku Cloud together. I'll share my current favorite trades, some things we're watching, and I'll be happy to analyze any charts that you are interested in as well. So when we get to that point, be ready. And you can type in some symbols and we'll run it through the analysis and see what they look like. Okay, so again, 3 key tools: Dow, Ichimoku, Elliott Wave. So Dow Theory, Charles Dow, pretty interesting guy. He wrote a series of articles in the newspaper that he founded, the Wall Street Journal, back in the late 1800s. Those editorials have been collected into what is called Dow Theory. One portion of that is just simply some definitions around a trend. And what he said was, hey, an uptrend, a bullish trend it's a series of higher highs, higher lows, right? And as long as this pattern continues where a market puts in higher highs, higher lows, higher highs, higher lows, you got an uptrend, a bullish trend. And a downtrend is a series of lower lows, lower highs, lower lows, lower highs. Well, that's super helpful because, we go long on something like I just showed. I'm long on XPO, right? It's not going to go straight up every single day. Every once in a while you get lucky, but for the most part, it goes up in these higher highs, higher lows. How do you know if the trend has continued? How do you know when the trend has ended? Well, it's good to have some definitions and some rules to work with, right? All disciplined and effective trading is rules-based. So the rules, for an uptrend are, it started when you get a higher high, higher low, and a new high. That's when an uptrend begins. And as long as it continues in this pattern, it's still an uptrend. When does it end? When it doesn't put in any more highs and it takes out a prior low. Really hard to call the absolute high in an uptrend, but you can certainly tell when it has ended. And if you got in back here and you got out here, you got a nice profit. And you can do this with very low stress, right? I remember when I first got into technical trading, I was switching from being a fundamental trader to a technical trader. And it was after the financial crash. And I got back in about 2009, and I got into a trade on Bank of America. I got in at $5. It went to 12. Get this nice winner. And it's like I was totally stressed out. When do I get out? I don't want to give away my profit, but I don't want to miss on future profit. What do I do? If I'd had these rules then, it sure would have been less stressful. And now that I do have them, trading's a lot more fun. All right, downtrend begins low, lower high, new low, right? That's the beginning. And then it's lower lows, lower highs, lower lows, and it ends when it's no longer putting in new lows and it takes out the prior lower high, right? So once you see that and kind of have it explained, it's like, wow, that's incredibly simple. But if you don't have that definition, it's hard to know. So I use this extensively as I analyze, when did a trend begin? Is it beginning? Has it been proven yet? And when's it ending? So it's good stuff. Thank you, Charles Dow. All right, Ichimoku Cloud. This handsome fellow is Goichi Hisada. He worked on the Ichimoku Cloud back in the 1930s. Ichimoku Cloud Japanese means Ichimoku Kinko Hyo. This means one look equilibrium chart. Okay, he started working on it in the 30s. He took a little time to develop it. He finally published a book outlining his theory and technique in 1969, and it's pretty widely used. It's available on just about any legitimate trading platform now, and it's pretty cool stuff. So let me pause and ask a question here for the folks listening in. How many of you believe moving averages matter? How many of you used moving averages in your trading? Just type in a yes or some kind of affirmative or negative response there. Kevin says yes. We got a bunch of yeses. David, Jurgen, Peter, Neil, Jeff. No no's yet. All right. James, depends on if momentum or not. Fair. Mark says no. That's all right. There's 1,000 different indicators, but most people on their charts and in their analysis do use moving averages to some degree. Well, Ichimoku Cloud, at its core, once you analyze the math and how the various elements of the indicator work, it's just a different look at moving averages. It's really a 3 moving average indicator with some derivatives and some interesting application. Okay, so a simple moving average that a lot of people are familiar with, simple moving average, it simply takes the closing average price, the average closing price over some number of previous bars. A lot of people use 2 or 3 simple moving averages. Of course, there's exponential moving averages and some other derivatives, but a simple moving average, average closing price over some number of bars ago. Ichimoku Cloud, instead of using the average closing price in computing the various elements of Ichimoku Cloud, it looks at the highest high and the highest low over previous bars. And it's got 3 look back periods, and we're going to go through that. And then there's some derivatives from that to create the Ichimoku Cloud indicator. But at its core, it's a moving average indicator, but it's taking the average at the highest high and the lowest low versus the closing price. And I think that's important because price actually went, intraday to different highs and lows. It's not just the closing price, right? So this is what it looks like on a chart. I got a screenshot here of TradeStation. And let's go through some of the elements. So first element here in Ichimoku Cloud is what's called the Tenkan line, or the fast moving average. I bolded it in yellow here on this chart, right? And it's the highest high, highest low divided by 2 for the last X periods, and that's a short period. It's a fast moving average. Shows the short-term trend, okay? And we look, and then this purple one we're going to look at is a longer trend. Crossovers on moving averages matter, right? But a fast moving average, it can have some fails. The bold line here is the Kaijun, or the baseline, highest high, highest low average for the last Y periods. It's longer than the yellow line, longer than the Tenkan. Okay, it's similar. If you were using a 2 moving average strategy, it'd be similar to the slow moving average, right? And so crossovers of fast over slow can indicate trend change, but you can have some false calls. Okay, the Senkou span A, which is the green line here, means Sinku means going first or proceeding. In baseball and Japanese, that's the lead person on the batting order, is the Sinku, right? It's the faster part of this cloud boundary area. And it's highly accurate in telling you what trend you're in, because when this Sinku A is on top, it's pretty good confirmation you're in an uptrend. When it's below, right, it's going down, right? It's the fast line, the Tenkan plus the Kaijun divided by 2, plotted over a third number of periods ahead. And then the Sinku B is the slowest part, and it forms the lower boundary here of this cloud. It's the highest high, lowest low divided by 2, calculated over a very long period of time. And then in classic Ichimoku cloud, it's plotted ahead. In my charts, I've actually reset that back to current because I'm really just interpreting it as moving averages. So you'll see that on live charts here in a minute. Okay. So the shaded area is called the cloud, Kumo in Japanese. It's the space between span A and span B. This is really what matters. In fact, on my charts, I finally took off. If you look at my TradeStation chart here, I don't have the Tenkan and Kaijun lines anymore, because the rule is what you want to look for is a fast over slow, Tenkan over Kaijun cross, and then price going above or below the cloud for a trend change. Well, if price goes above the cloud, it's axiomatic that you have cross. You don't need to see it, so I like to keep my charts as clean as possible. Okay, but this cloud shows you what trend you're in, and it also is showing you key support and resistance areas. And you can see in an uptrend, price goes up to and pulls back, up, pulls back to the cloud. And the thicker the cloud is, the stronger the resistance of this region is. And I actually like having a region more than absolute moving average line, right? So pretty interesting, pretty helpful. And then so this is what it looks like on TradeStation. I showed you a live chart, right? I think the Ichimoku cloud does a great job of identifying trends, both when they begin and when they've ended, and then predicting support and resistance areas for that trend. But I don't like Ichimoku cloud on its own. I like to use it in conjunction with, I talked about Dow Theory, and then I talked about Elliott Wave. Now, before we get into Elliott Wave, I'll ask another question. How many of you, when you hear Elliott Wave, you just kind of roll your eyes and you say, yeah, I looked at that and it was overly complex, and the Elliotticians were geeks and never could agree on wave counts, and it's subjective? How many of you had that response to Elliott Wave? And James says, LOL. And yes, and Neil says yes. Well, I'm here to tell you that Elliott Wave is easy. It's super easy. Okay. Elliott Wave is developed by Ralph Nelson Elliott. Interestingly, back in the same era that Goichi Asada was working on Ichimoku Cloud back in the 1930s. What Ralph Nelson Elliott said was, he said, it looks like there is a collective investor psychology, crowd psychology, that moves between optimism, pessimism, and natural sequences or waves. And that there's a series, kind of a recognizable pattern as crowd psychology shifts from optimism to pessimism in these waves. All right. And so here's the stylized or idealized 5-wave pattern, right? There's an initial move and a little pullback. Then there's a big move, and it's called wave 3. Excuse me. And then there's a wave 4, it's a correction, and then there's a wave 5. And then afterwards, there's this complex correction. Okay. So I only really care to trade wave 3, a nice big impulsive breakout, a correction after a big move, and then a continuation of the original trend. A complex correction can be tricky. I'm not interested in it. I'd rather just focus on 3 trade setups. Catch an impulsive breakout, catch a correction if there's good profit, and then a continuation of the original trend. You can flip this thing upside down, and bearish trends work and look exactly the same. So that's a quick look at Elliott Wave. Now here's this chart. So hey, Elliott Wave is easy. All you got to do is memorize these 144 pattern permutations of grand supercycles and cycles and primaries and super millenniums and all this. As soon as you dial this all in, you got it. Well, that's absolutely ridiculous, and I couldn't do it, and I have no intention of trying. But it doesn't have to be like that, right? Elliott Wave really is easy if you're just looking for very simple, clear patterns, right? And I only look for 3 trade setups. I have no interest in that 144 permutation nonsense. There's a great book written by Bennett McDowell called Elliott Wave Techniques Simplified. It's available on Amazon. So I did not write the book on Elliott Wave techniques, but I helped. I actually did write a chapter in this book. Bennett honored me by asking me to participate, and I was glad to do that. And so there is this very, very simple, repeatable, easy way to use Elliott Waves, and that's part of what I do in my training. So how do we combine them, right? Well, let's look here. Let's just look at it at an Elliott Wave basic, right? So I've labeled them here, right? If you think about that stylized pattern that we showed a couple slides ago, right there. Here's this pattern, 1, 2, 3, 4, 5. Well, here it is on a chart, right? This was Vail a while back before everything went south on them, right? We see here's an entry, wave 3 entry using what? Dow Theory, because we got wave 1 and we combine that with Dow Theory. Oh, there's a high. There's a higher low. That's called wave 1, wave 2, and a new high. Well, according to Charles Dow, that's the beginning of an uptrend when this high is taken out and a potential big move coming. And by the way, look, at the same time it put in a new high, it was changing trend, breaking above the Ichimoku cloud. There's a great entry, and we can ride this thing all the way up for a really nice move, right? That if the entry is down here on Vail at 3 and some change, and it went all the way up over 6, well, that's 2x. That's not too bad, right? Called out a pretty big move. And then look, after the correction, right? Here was 1, 2, 3, 4. Here comes wave 5, and we can see after the correction, which by the way was a low, lower high, new low. There's the correction. May not have been enough profit in there. And you can also predict how deep's the correction going to go. Well, you see these lines here. These are Fibonacci retracement lines. 70% of wave 4 corrections fall down between 38.2 and 61.8 Fibonacci retracement. So you can predict with reasonable accuracy where the thing's going. And look, there it went, right into that zone. And then high, higher, low. So we had this high. You go, why not here, right? High, higher, low, failed. Wasn't a new high. So we do it again. High, higher, low, new high. Bam, wave 5's beginning. Here's your entry at $5. It went to 6. It's about a 20% move. Not as good as the double back here, but it's not done. Here's the target zone, which is a Fibonacci extension region, right? So Fibonacci retracements we use to predict where the retracement is, the correction is going, and we use Fibonacci extensions, which take 3 data points, right, to predict where the follow through is going to go. So pretty good stuff, and that one actually did make it into the target zone. All right, and then we can manage trades. Where do you place your stop? Well, after the initial move up, high, higher, low, new high, put your stop under that higher low, and then trail it to new higher lows. And then finally, when the trend ends, get stopped out. Let the trend run until it's proven using Dow Theory that it's over. And there's the correction. Wasn't really enough profit there. Next trade takes off. Here's our initial stop. We just keep trailing it up as new higher low points are put in. We let it run up into the target and then let it finally stop out for a pretty nice win. We just use Dow Theory to manage our stops. So just keep it pretty simple, right? So let's take a look at some symbols. I showed you a couple trades that I like, and let me walk through the setup here and what I'm looking for on this trade. So, and meanwhile, yeah, type in a few symbols that you would like me to analyze, and I'll give you my opinion. Now, here's the thing that frustrates people about Elliott Wave is, they go, okay, I want to go look at Apple, or I want to go look at Micron, right? Well, the Elliott Wave pattern may not be present on a particular chart. A lot of charts are erratic. right? Chaotic. You go look at General Motors or Tesla, for crying out loud. There's no pattern. So every chart we look at is not going to present itself, or not going to be organized following an Elliott Wave technique. And if I want Elliott Wave trades, I'll just pass on it, because there's thousands of symbols to go look at. There's always good trades to find. Verisign, right? Hey, what do we notice? That Verisign has been in uptrend for a long time. It started back here at $70 and it peaked up at 220, 3x. I would call that an uptrend, right? It had a little slowdown in the middle before it took off. That wasn't a wave forward, did not correct deep enough, right? But what we're looking at now is the formation of a correction, right? The formation of a correction. Let me take, we were doing a little short-term thing there, right? So if this was the whole trend, I can put these Fibonacci retracement lines on here. Let me get rid of this. Okay, we can do a, where did this trend begin? Well, it began clear back here, right? There's 1, 2, so I'm going to do a Fibonacci retracement from 2 to the top of 3, right? And we can predict that Verisign is going to retrace into this zone down here, okay, between those blue lines. So has the downtrend, has the correction on Verisign begun? Well, let's look at a few things. Look at price action on this. If you remember my Dow Theory discussion, right? Uptrend is higher highs, higher lows, higher highs, higher lows, higher highs. Right, there it goes. What happened? Low, lower high, new low. Low, lower high, low, lower high. Right, we've been in a downtrend for a while on Verisign. And what else do we see? This light line is, I like to look at standard moving averages as well. This is a 50-day moving average. This is a 200-day, the heavier line, right? And then this shaded area, of course, is the Ichimoku cloud. So what do I got? I got wave 3 up, right? I've got wave 4 pretty clearly starting, and a target down here. So I got a kind of a clear Elliott Wave count. I've got the 50 crossing under the 200. Anybody know what that's called? When the 50 crosses under the 200? It's a really scary name. When it crosses over, it's called a golden cross. What's it called when the 50 crosses the 200 on a daily chart? Anybody know? Neil, Death Star, Death Cross. Yeah, ouch. But it's happened, right? We have a death cross, and we've got price under the Ichimoku cloud. So everything's starting to line up, right? Good wave count, check. Under the Ichimoku cloud, check. Moving averages looking good, check. Right? Got a good target, check. So I like this trade to the extent that I went and put money in it. And I've got my stop placed at this prior high. That's where this red line is. Because if it were to go hit that and go above that, this lower low, lower high, lower low, lower high thing would fail, right? The thesis, the definition of downtrend would be violated. So we would want to bail out here if this goes above here. And then when, not if, right? When we put in a new low, we're expecting price to do this down into our target zone, right? I'll trail my stop to these new highs, right? As they're established. And then I determine my position size by taking the difference between my entry and my stop, and then calculating what 2% loss the account would be. All right. If I were to hit the stop, I don't want to lose any more than 2% of my account. And then we got a nice target, right? So if this is my risk right here, this distance, and this is my reward down into here, this is, 4 or 5x. My reward to risk is great. And for me, that's important to have on every single trade, is to have a positive reward to risk. If this distance were larger, I have no interest in the trade. I don't want to have the potential to lose more on a trade if it fails than I could make if it wins, right? If I keep my payout ratio, the ratio of my winning trades to my losing trades, the average size at 2x or better, I can lose half my trades. No pressure. I'll be a very profitable trader if I can keep my payout ratio high. But the only way to do that is to take trades that have big potential. Let's look at XPO. So I went long on XPO. And you can see here kind of a narrow focus. Well, it's clearly in an uptrend, right? High, higher, low, high, higher, low, high, higher, low, high. It's in an uptrend. Where's it going to go? And what's the big picture? What's the context of XPO's current move? Well, doesn't this look an awful lot like my stylized Elliott Wave chart, my pattern? This looks like an Elliott Wave pattern. In fact, it is an Elliott Wave pattern because we have, 1 and 2 was back here. The important thing was 3, a big impulsive move up from $20 to $110. That's big in my book. A correction into the Fibonacci retracement zone, went a little deep, but stayed above this disqualifying level of 76.4, found a bottom, and now we have this uptrend, high, higher, low, high, higher, low, high, higher, low. Right, we have this uptrend, and we've got a target in the Fibonacci extension zone. And so I like this trade, right? They're past earnings, so now we got 3 months of clear running without any new disruptive information, unless the CEO sleeps with an employee or something. McDonald's guy. Don't these guys learn? Anyway, right, we don't have earnings coming. We got a clear run. We don't have any major pivot points here. Looks like we got a straight shot up into this target zone, 101 to 139, and we took an entry at 82 bucks. So let's let it go. We got our stop currently here. We're about to trail it to here. And when this thing plays out, we'll just keep trailing our stop up until we get into the target zone. We'll close the trade. That's how it works. That's the idea. So you guys have typed in some symbols, and so what I'm going to do is pull them up and take a look. And you typed in an awful lot, and I won't be able to keep up with them all, but I'll knock out as many as I can here, and we'll see how it looks. And now just the disclaimer, right? Finding great trade setups is like a needle in a haystack, man. You got to look at 10 or 15 charts to find a good trade. So I'm going to look at your symbols. Just be prepared. I'm probably not going to like most of them, but that's okay. I'm happy to look and offer my my analysis. And who knows? There just might be a needle in a haystack. First up, MA. I think that's MasterCard, isn't it? Well, what a beautiful trade. And you can see I've analyzed this one before. It's in wave 5. The problem with MasterCard, it's just textbook. 3, 4, 5. If you've been following anywhere along here, you could have got a great entry. But the problem is it's in the target zone. This is a very mature trend, and now you can see it's starting to get into this complex correction, and typically there's some kind of an A, B, C in the opposite direction. So I think it's a little late to try and go long on MasterCard, and it's a little early to try and short it. We're still above the 200. We really haven't put in low, lower, high, new lows to indicate any kind of big move down. So it's just in a complex correction. It's the only way to put it. So too late to go long, too early to go short. Boy, that was a great run, wasn't it? Dust. And I think dust is it's a gold thing. It's a 3X thing. Direxion, yeah, the gold miners 3X. Be careful with these leveraged ETFs. I think they're okay, very short-term trading instruments. You don't want to hold these very long. You want to go read the prospectus and really understand how they settle and what they're based on. A lot of them, roll futures contracts and do all kinds of crazy stuff. And you can get burned if you don't understand that if you're holding it long-term. But they're reasonable short-term trading things. But boy, isn't it stuck? Isn't it just stuck? Look at this channel. You can put an upper and a lower boundary on this, kind of in this last 30-day period. It is stuck in a very, very tight channel, not a very exciting trade. Now, if it were to break, I would not take the initial break. I like to see things proven. If it breaks out, there should be a pullback and then a new entry opportunity. And this is the one that you would want to try and catch. But I wouldn't trade it in here. It's a mess. That's my opinion. Shopify. Okay, Shopify. There may be a trade here. So what do we got? Big move up, right? Big being defined as $129 to $400. This is wave 3, right? And let's reset these Fibonacci lines and let's see where the potential correction could go to. Something like this. So a target for this correction is between these blue lines, and you can see it's already made it there. Now, wave 4s typically move in A, B, C. So we may have, down here into the mid zone, we got the 200-day moving average that could provide some support. It's down, it was down big today, 3.57. And for me, if I were to take this trade now, put my stop here, right, we would be taking an entry here at current price, assuming it opens there, and our target's here. Well, what's the problem, right? If that's my stop up at the last pivot, the distance from here to here, the amount I could lose per share is bigger than the amount I could gain per share at the potential support and target zone. So it's a nice downtrend, but the profit potential, the stats on the trade don't work for me. Hope that makes sense. MIC for David. That is an odd and kind of ugly chart. Remember I said that you're not going to see an Elliott Wave pattern on every chart. Well, here we go. Had a big move down, had a retracement, and then it went totally sideways, kind of a sloping channel, got even tighter, probably had earnings or some kind of news out here, and it broke out. I would not try to chase that. Quite often gaps will get filled, and it's trying to come back. So it's just a little erratic for me. There's nothing, I don't have an edge on a chart like this. I just don't have an edge. I need an edge in my trading, right? But it was kind of fun to look at. Let me skim down here, see if there was any others. Roku earnings tomorrow. So here's the thing on swing trading, Elliott Wave, I don't take trades into earnings because you're going to get new information and you often get gaps and volatile moves, right? So I wait for after earnings, let it settle, and then see what we got. Roku, here's a wave 3 impulsive move. Here's a correction. Looked like 5 was getting going, so look how it pulled back to the cloud. So if it can reverse on earnings and head back up, you could have a price target somewhere in the region of 190 bucks. If you wait for earnings, I would wait for a new high here. If it does reverse and head up, you can put your stop at this low, and you're going to have a target, up in here, and you got a nice reward to risk. You just got to let the earnings come out, see how it goes. If it gaps up to here, well, it's too late. You missed it. There's other trades, but that's worth looking at. James wants to know, what are the thoughts on gold? So we looked at dust, but let's just look at gold futures. I like to look at the futures if I'm going to trade gold, and then if you're going to do a longer term trade, you can decide if you want to trade with GLD or the miners or something like that. So gold has had a pretty good run up, right? You would really call this wave 1, 2, 3, and we're in this complex correction. Now gold, is one of the most heavily traded commodities on the planet. It's important. I would step back from this daily chart, and before I started trying to trade it, I would jump out to a higher time frame and go, what's the big picture on gold? So let's go to a weekly chart and go, okay, the big picture on gold is it's kind of bearish, isn't it? Had this big low down at 16. We're just finishing a correction, and it kind of looks like we're heading up or down, right? Down. And now we go bounce back out to a daily and go, in the short term, it looks like we had this move up and we've started a correction. So I think when I compare the long-term picture with the current term, they kind of agree that we're probably looking at some kind of pullback on gold right now, at least in the on a daily chart in the near term, down here to between 1435 and 1435 and 1350. And is my oscillator 534? No, my oscillator is one, it's called the OWL, it's from Trader's Coach, but you can replicate this with a price oscillator indicator with 5 and 35 settings. And Stephen asked, why am I not using TradeStation 10? I'm still on 9.5. Because upgrading is a hassle. And I've got a coworker using 10, so she's using it, and we kind of compare. 10's still kind of buggy. It's been out a year, and it's still a little buggy. So till they straighten it out, this works just fine. At some point, I'll have to upgrade. They drop support, but hopefully they get some more patches out there. I think TradeStation was trying to mimic TOS with 10, and I don't think they did a very good job. All right, hey, we got a few minutes left. I want to wrap up the presentation. I want to let you know how you can follow along, right? So we looked at a lot of symbols. I showed you 2 trades I like right now. Still got good entries. I do have a special offer. You know, if you liked the analysis you saw and what I'm doing here, and you want to follow along with the trades that I'm taking and my training and all that kind of stuff, I'd like to offer you to jump in and check it out. It's a pretty reasonable offer. You can check out my stock and options pick service. You can get it for 30 days for $37. After that, it's, if it's a good fit, it's $97 a month. That's a 25% discount off the list price. That's 100% money back guarantee, so there's low risk, right? Check it out, hang out for a month, see if it's a good fit. If it's not, no questions asked, no hard feeling, I'll give you a refund. And I think Dave is posting the link. So you can hit that and go check it out. Yeah, there it is. Okay. And what do you get with this service? Well, you get a watch list of potential trades that I'm watching. Like I'm watching NVIDIA right now. I'm watching OXY right now. I got a handful of candidates, not quite ready, but getting close. You get the watch list. You get alerts if we're going to take a new trade. Email, text message. I also use what's it called? The name escapes me. It's a cool worldwide app now that we're using for messaging. It'll come to me in a minute. So you get alerts when we take a new trade. You get the exact details of the trade, the entry, the stop, the target. Most trades can be traded either with shares, if you like trading shares, long or short, or with option contracts. I provide a complementary parallel option trade for the, everything starts with the chart and the directional move, and then the decision is, do you want to trade with shares, do you want to trade with options? I give both paths, both recommendations. You get alerts when we make changes, move a stop, take profit, close a trade. So, step by step through the life of the trade. You get access to a live trading room Monday through Thursday, right at the market open. You can attend if you like. It's not required. A lot of people come in and just like to ask questions like we did here and review charts, but you can come see as we're scanning for finding and qualifying trades. We do record it. There's a recap. There's a weekly live chat session for those who can't make the mornings, Wednesday evening, 6 o'clock Pacific, 9 p.m. Eastern. I offer a one-on-one consultation when you sign up. Get a link to my calendar, you can book some time, we can get acquainted, get you off to a good start. I offer risk management and option trading tools and training as part of the service, so you can follow along and manage risk the way I recommend it. You get ongoing support and training. I get great feedback on the support that we provide. And wait, there's more. Worldwide messaging application. Telegram is the name of the app there. I knew I'd get it. Telegram is the application, and it's really good. Steven's asking, what's my track record? It's on my website, followmetrades.com. My website is, I post a summary of every year, and then there's buttons you can click and go see the trades I took every single year, every single trade. and it's audited by a third-party CPA firm. So I believe in complete transparency in my trading, and the results I post there are verified. That, you know, they get my brokerage statements and they check and say whether or not I did what I did, and I wouldn't go through that effort if I weren't doing it. Okay, and where was I? Oh, there's more, right? You get all this, and if you sign up as a result of this webinar, you get my Ichimoku Cloud training course. So I've written a course with my proprietary cloud settings, a written study guide, training videos, a trade setup cheat sheet. That course is on my website for $247. You can get it for free with a 30-day stock picks trial if you sign up at the link that we have. And look at that, I brought it in right on time. And thank you traders for being here. Thank you, Dave, for hosting me and inviting me back here. I sure appreciate it. I sure enjoyed it. And I think we're out of time.